This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Diversification is supposed to be a good thing, right? For decades, the experts have told us to spread our investments across multiple asset classes to manage that proper balance between risk and reward. But in recent years, and even dramatically more so in recent months, investment performance has become concentrated in literally a handful of tech behemoths. Up next, what gives? Is it time to ditch stodgy old-school thinking? Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. Great to be with you as always. At some point, we've probably been taught, or at least heard the concept of modern portfolio theory, first put forth by Harry Markowitz way back in 1952. It's essentially a mathematical framework for assembling a portfolio of assets such that the expected return is maximized for a given level of risk. In practice, and in plain English, means that you ought to be better off over time diversifying across a wide variety of different asset classes, small and large stocks, international and domestic stocks, stocks and bonds, and so forth. But recent years, being disciplined and patient enough to adhere to such a theory has been a challenging exercise, to say the least. U.S. large cap growth stocks have been, in most years, going back to the great financial crisis in 2008, the single best place to have your money. And more specifically, you've been rewarded by owning concentrated stocks in a handful of mega cap tech names. If you try to diversify away from it, it probably led to worse returns than the S&P 500, and in some cases, outright losses. Remember, the S&P is essentially a U.S. large-cap growth index dominated by those mega-cap tech names. Meb Faber, the renowned fund manager, he said just this week that we have a bear market in diversification, that a global asset allocation model has trailed the S&P 500 in 13 out of the last 15 years. He said, quote, "If your neighbor has all their money in the S&P, then you look like a moron," end quote. Diversifying for some has led to what I've called diworsifying. So I thought it'd be useful to drill down a bit on this current reality and offer some thoughts on how to think about what you might expect going forward. Before I get into that, obviously this was a newsworthy week. I'm not going to talk too much about the macroeconomic backdrop, but in one day, we got both the monthly CPI data, Consumer Price Index data, and the latest Fed commentary. Not a whole lot changed, actually, but I think the main takeaways for me is that the consumer prices did not increase for the first time in 2 years. Okay, 2 years. And actually the next day, on Thursday, producer price index, which are wholesale prices that companies absorb and theoretically pass through to consumers, also was flat for the first time in a year. So yes, prices are higher, of course, than they were a few years ago, but the actual inflation rate, which is a year-over-year change, has decelerated significantly. The Fed didn't really change their outlook too much. They basically said that they wanted to get a few months more of data before they do anything differently. But I think the story remains the same. Rates are likely to come down. May not come down anytime soon. There's still, I think, a third of the Fed governors that indicated that they think rates will stay the same this year. About another third expected one cut, and then the remaining third expected 2 cuts. But bottom line is, if you still think that inflation's running at 8, 9, 10%, you're not paying attention. We're in a disinflationary mode, and I think that continues, which ultimately I think augurs certainly better for the bond market, because that's been the big story for me over the last couple years. It's not so much the stock market. I mean, I know the stock market gets all the attention, but it's been the bond market. The fact that we've been mired in the longest bond bear market in 4 years. Would not be surprised if that comes to an end here over the next 6 months. We'll see. Stay tuned. But back to the topic at hand, and kind of what precipitated my thoughts today were sort of looking at the performance of the broad market averages this year. And it was pretty stunning. I was doing some writing for the show back on Thursday, and as of Thursday, the Dow for the year without dividends was only up about 2%. Only up 2%. S&P 500 was up over 13%. The Russell 2000, which is the main benchmark for small stocks, a whopping 0.81, essentially flat for the year. And then the two international benchmarks, the MSCI EFA, which is developed markets like Japan and Europe, up a little over 6. The MSCI emerging market, only up a little over 4. So incredible divergence, right? I mean, there's a pretty big difference between over 13 on the S&P and 2 for the Dow. And I would argue the Dow is actually a little more representative of the broad economy because it's not as tech-centric as the S&P. So that was kind of got me thinking about this and the whole concept of diversification, i.e., are you worse off by diversifying your exposure away from large cap tech? So that's really what I wanted to talk about. I read a piece from James McIntosh in the Wall Street Journal. He was talking about this divergence at the individual stock level. And he noted that in the past 3 months, we've seen more 10% swings in a day than at any time in the last 30 years, relative to the fact that the S&P as a whole hasn't been volatile at all. So he's making the point that there is a ton of stock volatility at the individual stock level. I've used that analogy before of a tsunami under the surface. I mean, if you're sitting on a boat and there's a tsunami coming ashore, you may not even feel it. It might just be a ripple, even though there's tremendous violence 30, 40, 50 feet down. He also noted that the implied, if you look at the options market, the implied dispersion of stocks within the S&P over the next 30 days is at its highest since the data began in 2014. So there's a lot going on. There's a lot going on. And as you know, the S&P is right around its all-time high, but the list of 20-day new highs has actually been shrinking. In fact, according to FactSet, more on the New York Stock Exchange, this week, more issues hit new lows, 52-week lows than highs, and more New York Stock Exchange issues are declining than advancing. In plain English, this is a shrinking market. We had broadening for most of the last 6 months, but in the last few weeks, we've been shrinking. The number of stocks doing well has been shrinking. One more sort of data point on that just for you to chew on. Bespoke Investment Group came out and said that if you divide the S&P 500 into deciles by market capitalization, the only decile that is positive so far in the second quarter, the only one positive is the one containing the 50 largest stocks. The other 450 some stocks in the S&P on average are actually negative for the quarter. So, if you're looking at your statement and you see, 2 or 3 stocks up and 20 stocks down, you are not alone. That is what's going on in the market right now. And it's not just within the S&P 500 when we're talking about these types of divergences. I mentioned earlier the Russell 2000, which is the small cap benchmark that a lot of people follow. It tumbled to its lowest level relative to the S&P 500 since 2001. 2001. And by lowest level, I mean the ratio of the Russell 2000 relative to the S&P 500. You have to go back 23 years according to FactSet data. What about the equal-weighted S&P, which strips out market cap and just values all the 500 stocks equally, versus the cap-weighted S&P? Lowest level since 2009, according to FactSet data. And I could go on. In fact, this is the last time so few stocks outperformed the index for 2 years in a row was the late 90s, which of course was the period leading up to the dot-com crash. Well, what is doing well? Well, it's a lot of those tech names at the top, right? The concentration in the top 3 holdings in the S&P, Microsoft, NVIDIA, and Apple, is now over 20% of the S&P. That's the highest ever, or at least going back to 1980. Highest ever. 3 stocks, over 20% of the S&P 500. And that's been kind of backed up by money flows. So Strategas came out with this week, the research group down in D.C., they came out and noted that since the market bottomed last year, October 27th, you've had almost $18 billion come into technology funds. All the other sectors in the S&P, $4.1 billion in outflows. All the other sectors are losing money. It's all going into technology. Same thing over the last 12 months, almost $20 billion into tech funds, over $7 billion out of everything else. So, that explains a lot of what's going on. And, I don't want to belabor this point, but if you look at a lot of the exchange-traded funds out there that are growth-oriented, and I'm not going to get into any specific names, but so many of them have anywhere from 20 to 35% of their holdings or portfolio just in two stocks. Just Microsoft and NVDA. So be very careful of what you own. Now it's worked now, right? Worked so far this year because those stocks have done well, so more power to you. But be careful what you own. And if you own multiple mutual funds, multiple exchange-traded funds, particularly if they're growth-oriented, there's a good chance they all own the same stuff. And they own the same stuff in concentrated positions. So you might think you're diversified, because you have one from one mutual fund company, another from another mutual fund company. But if the top 5 holdings and if the weightings are all the same, all you have is a concentrated position in 2 or 3 companies. One thing I haven't mentioned is another distortion, how growth stocks have blown away value stocks. In fact, that relative performance is now the highest it's been since 2020, very close to where it was in late 99, just on the precipice of the dot-com collapse. Very close to that. And if you break it down a little bit further, a lot of it has to do with the tech weightings in those indexes. So if you look at, this is from FactSet, if you look at the S&P 500 value index, it's a roughly 8% information technology, i.e. tech, and almost 23% financials. Well, look at the S&P 500 growth index, over 49% information technology / tech, only 5% financials. So the biggest difference between the growth index and the value index is the percentage of financials, which have been relative laggards for an extended period of time, really going all the way back to the financial crisis in 2008, and how underweight the value indices are in technology. That is the major reason. The takeaway for me being, hey, we're still value investors. We still look for value. We still look for growth at a reasonable price. But to be absolutely dogmatic and just buy like a value index that isn't going to be nuanced, it's just going to, like I said, be an index, passive investment, you've got to be very careful with that because chances are you are completely on the sidelines with what's going on with AI and some of these other trends. Again, it goes back to knowing what you own. I'm not going to talk a lot about the international markets today, but similar divergence. U.S. equities are once again outpacing the rest of the world. That's a trend that's persisted for over a decade. And it's also something to do with tech. If you look at the top 10 holdings in the European index or any sort of international index, they are much less tech-heavy, much more concentrated in energy, automobile companies, chemical companies, much more industrial-oriented, much less IT and tech-oriented. So tech, not to be redundant here, but tech giants are dominating the field like we have not seen before. Look at Apple, for example. They've been in the, according to FactSet, they've been the largest stock in the S&P 500. Forget this, 99.96% of the time since 2014. And it's up 861% over that period of time, 4 times better than the S&P. That's unbelievable. Think about that statistic for a second. Almost 100% of the time, they've been the largest company in the S&P for 10 years. Very rarely happens. But here's the key point. I'm not saying this is necessarily a bad thing, and I say that because it's been backed up by fundamentals. Normally, when you have narrow leadership in the market, right? It's typically the result of deteriorating fundamentals across the board. So when the profit cycle decelerates, investors tend to gravitate to fewer and fewer companies that can maintain growth. As fundamentals deteriorate, growth becomes scarce. But that's not really what's going on right now. Earnings are actually going higher, right? Analysts have been taking their estimates up. Economy, it's not gangbusters, but the economy is expanding. And these mega cap stocks that are dominating the index are doing so due to their sheer size and contribution weights. In other words, they have not just outsized market capitalizations, they have outsized profits. Outsized profits. The guy who has written a lot on this is Morgan Stanley's Michael Mauboussin, Maubussin. I read his stuff all the time. He talks about the concept of economic profit. It's actually a metric that he's come up with that's pretty similar to return on invested capital, but he calls it economic profit. According to him, in the 10 years through 2023, a period when, of course, concentration has risen significantly, the top 10 stocks averaged about 19% of the market, of the S&P, but 47% of the economic profit. Last year, I haven't seen any data so far this year, but in last year, 2023, the top 10 stocks earned almost 70% of the economic profit, but were just 27% of the market cap. So obviously it's gotten exacerbated recently by all the inflows into these companies, from investors, the media hype of all these companies, the media hype of AI in general. But it is to some degree more than backed up by the actual fundamental performance of these companies. And again, if you go back to the dot-com bubble, the three biggest names at that point were Microsoft, General Electric, and Cisco, I believe. They were trading something like 60 to 90 times earnings. The biggest three today, Microsoft, NVIDIA, Apple, 36, 45, and roughly 30 times forward earnings respectively, according to FactSet data. So nowhere near, I'm not saying really making a valuation call here, I'm just making the observation that the valuations are nowhere near what they were 99 and 2000. I just wanted to mention NVIDIA specifically, and I'm not really offering an opinion on NVIDIA. I just wanted to make the point. It's not a stock that we own widely in our portfolios, although we do have some clients that have the shares. I have full disclosure, I have a tiny bit of NVIDIA in my own portfolio. It's literally less than half of 1% that I own. Bought it a long time ago. You can consider that as a conflict of interest. So just keep that in mind. And by the way, whenever I mention an individual company, I haven't offered any research opinions today for sure, and normally don't. I try to present a balanced perspective. But even companies I mention in passing, just to make an observation or a point, make sure you do your own homework if you're not a client. Don't just hear it on the radio, hear it on the podcast, and decide to go implement it in your own portfolio. Make sure you do your homework. If it's something that we are buying for clients, if you're listening, you can assume that we've done some due diligence and feel pretty comfortable that it's suitable for what you're trying to accomplish. But NVIDIA, the main thing I wanted to mention about NVIDIA is it's attracted so much attention that there have been 40 trading days this year, 40, according to Goldman Sachs data, where NVIDIA traded more in dollar value than Microsoft, Apple, Google, Amazon, and Facebook, i.e. Meta, combined. You literally have all money going into NVIDIA. And as of this week, NVIDIA was roughly, give or take, 40% of year-to-date S&P 500 performance. So, that's a sword that cuts both ways, right? So far, it's been a good thing, but just understand that if NVIDIA ever misses their earnings or offers a more tempered forecast, that could cut the other way as well. And this has almost never happened. I was reading some data. There were a couple years where Apple and Amazon did have outsized influence during negative S&P 500 performance years. This is according to Strategas. Apple in 2011 went up 25% in a year where the S&P was negative, so that was a huge percentage contribution. Amazon went up 118% in 2015, but again, the S&P was down for the year that year. But the only other year where there's been anything close to what we're seeing today, which is an outsized contribution in a positive year, was ExxonMobil in 2007. ExxonMobil in 2007 was up 24%. That was about 23% of the S&P that year. As I mentioned, NVIDIA now is close to 40. As I mentioned, I'm not really going to get into a conversation or a dissertation on NVIDIA today. Certainly a lot of it has to do with their fat profit margins. They can essentially charge what they want right now. They can essentially charge what they want because there's tremendous demand for their product. They have essentially a chokehold over the most powerful chips needed to train and run today's AI technology. But that's probably not going to last forever. The company has a lot of competitors, Intel, Qualcomm, Apple, that have ramped up their efforts in AI chip making in ways that probably at some point NVIDIA will be challenged for. So I think that will be the big thing to watch on NVIDIA. And again, I want to be clear, I'm not really offering an opinion on NVIDIA. I just wanted to make sure you're aware the amount of growth and margin preservation and market share preservation that has been extrapolated out many years into the future to justify today's valuation. We'll see what happens. Not knocking NVIDIA at all. I will say, we've seen this story before. People say this is unprecedented, and some of it is. The sheer size of the company is unprecedented. But from 98 to 2000, Cisco, if you recall, quintupled in price. And then from 2000 to 2002, it collapsed because you had a hardware glut arrive just as the market downturn dampened demand. Not saying that's going to happen in this case, but keep it in mind. I would also say, if you look at FactSet estimates, the 10 largest stocks in the S&P 500 will likely see earnings per share growth slow during the second half of the year, while the rest of the companies in the index in aggregate should see acceleration. This is what estimates are currently calling for. By the way, this year, there were already 160 companies in the S&P that saw their trailing 12-month net income increase by 25% or more. That's less than NVIDIA, but a lot higher than some of the other mega cap tech names. So that could, and I say could, that could be setting us up for a dynamic where these mega cap tech names pull back or maybe stall out for a bit and the rest of the market does better. Would not be surprised at all to see some broadening, especially if interest rates keep coming down like they had the last couple of weeks. Would not be a shock to me if dividend stocks started to increase their relative attractiveness again. Remember, nobody's needed dividends because you can get 5% in cash, but if it looks like rates might come down, that could change. So I don't want to repeat myself, not making any sort of judgment call on NVIDIA or any of these other names. I just wanted to use them as examples and also make some kind of factual observations, if I could, about the current state of affairs. I've referenced this piece from Vanguard before. Vanguard periodically, every quarter, they come out with their 10-year kind of return forecasts for various asset classes. And I'm not saying they're right, of course, but you know, Vanguard's the largest asset manager in the world, so it probably makes sense to pay them some attention. For U.S. equities over the next 10 years, they're only forecasting 3.3 to 5.3% annualized returns. U.S. growth specifically, 0.4 to 2.4 per year, annualized. But look at some of the other asset classes, going back to what we've been talking about, the idea of diversifying, the idea of modern portfolio theory. U.S. value stocks, they see 4.1 to 6.1. Small cap, 4.3 to 6.3. Global equities, 6.7 to 8.7. Emerging markets, 6 to 8. All those asset classes, they expect much better returns than what U.S. large cap growth could offer. And maybe most interestingly, they have bonds expected to return between 4.3 and 5.3. with roughly a third of the median volatility. And my manager here, Warren Wright, he reminded me of an old analogy, the baseball analogy, that you have 9 people in the field for a reason. You don't know where the ball's going to go. If you knew the ball was going to go to the right fielder every time, you'd have 1 guy out there. You wouldn't have 9. We've been in an environment the last few years specifically where you've only needed 1 fielder. You've only needed to buy a handful of tech stocks. Of course, we didn't know it at the time, but we know it in retrospect. Based on what I'm saying, based on where earnings are going, based on valuations, based on money flows, do not be surprised if we get something very different in the next few years. So this is not a call to sell your tech, to dump your tech, to get out of NVIDIA. I'm not making any such call. I'm just saying be aware of what you own. Be aware of where your concentrations are. Be aware of what could happen if everything goes the other way. Remember, I've said for many years that if everything in your portfolio is going up at the same time, there's a good chance you're doing something wrong. Because it means if the conditions change, everything could be going down at the same time. All right, so what has been diversification, I think it could be potentially different type of situation going forward. So I'll leave it at that. Up next, stick with me. I have some updates for you on a few of the top portfolio holdings that we have here, as well as a new holding, a name we have never owned before. So I want to make sure I share some details on that. Back in a second.
The political temperature is only going to get hotter. It doesn't mean you need to lose your cool and make emotional decisions. Tune in every week to hear Simon Hamilton and Chase Hinderstein discuss the latest financial trends and what investors need to know. To help filter out the noise distracting you from your sound portfolio management and how to become a better informed, wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to our Wise Investor Group podcast. As promised, I wanted to just catch you up on a few individual names, but also wanted to give you a quick few factoids on a new recommendation, a name that we just started buying for our clients for the first time. By the way, they're headquartered literally 10 minutes from our office here in Chantilly, Virginia. And as I mentioned earlier, but I'll mention it again, this is a name that we've started buying for our clients. So if you are a client, you can feel, I think, pretty confident that we've done our due diligence and we've determined it's suitable for your portfolio. If you're not a client, remember, I can't manage through the podcast. You really need to do your own homework, your own due diligence, make sure it's right for you. This is not a name that I've yet purchased personally, but when I do, I will let you know because I try to own everything that I own for my clients, and as you know, that represents a conflict of interest, so you have to weigh that in your decision making. But the company's name is Parsons Corporation, symbol PSN. Like I said, headquartered just locally in Chantilly, Virginia. Very interesting company. And I say interesting because they have really a diversified business line with exposure to really areas of opportunity that have sort of a decade's worth of visibility. And specifically, they offer next generation, both defense and global infrastructure exposure. They're positioned to high-end growth markets, like I said, all of which are estimated to grow between 5 and 12% a year through fiscal year 2026. This is according to the company's own estimates, by the way. And then they've also done some things recently to increase the durability of their revenues, such as the transition from building infrastructure into actually ongoing management of that infrastructure. But specifically, their business is broken down into two major divisions. One is what they call Federal Solutions, which is primarily defense and intelligence, but cyber, for the most part, cyber defense, cyber intelligence. They're not involved in a lot of hardware. They do a little bit of that, but it's both offensive and defensive. So everything from essentially creating cyber attacks on foreign adversaries to actual missile defense systems. So they have a very robust cyber defense business. And then the other part of it is what they call CI, critical infrastructure. So this is planning, engineering, and management services for complex infrastructure, tunnels, roads, highways, bridges, both here in North America. They also have some real key opportunities in the Middle East, building out some of the new sort of modern concept cities in Saudi Arabia, for example. So it's, like I said, a very much a diversified company with a lot of different expertise in areas that have, pretty bright not only demand, but also funding visibility. If you look at their company's own projections, they have fiscal targets of 4 to 6% revenue growth over the next few years, pretty significant margin expansion opportunity as well. They generate a lot of free cash flow, really good balance sheet. If you look at the most recent analysis from the analyst here at Raymond James, what was interesting is the stock actually sold off after their earnings report, and they were actually surprised. They thought it was a pretty good quarter, but maybe it's a possible entry point here. They beat the street on the bottom line. They beat the street on the top line. A couple takeaways that I thought were pretty interesting. What's called their book-to-bill ratio, which is a ratio of kind of new orders versus existing orders, up to 1.4, which means they have a really strong backlog of work to do, which obviously is a good thing. And it was the 14th quarter in a row of a book-to-bill ratio over 1. Not only that, they had something like a 78% win rate, which means when they bid for a product or business, almost 80% of the time they won that business. So that bodes pretty well for the future. As I mentioned, they took up their estimates on the bottom line, took up their estimates on the top line. So it's an interesting business. I think we always talk about secular stories, companies that have long-term business outlooks suggestive of future growth. We're not just looking for something that's going to outperform over the next quarter. And Parsons has exposure to so many areas where we have that type of confidence. I think that if you're looking at the potential pitfalls, one, of course, would be an economic downturn. Certainly in a recession type of environment, a lot of these types of projects get stalled, right, or delayed. Who knows how that would impact them, particularly here in North America. Some of the municipal projects are involved in. Certainly a haircutting of the defense budget could be a risk for them at some point. And they're reasonably priced, but relative to their peers, they trade at a slight premium. Okay, so yes, they're growing faster than their peers, but they trade at a slight premium in terms of valuation. So you have to take that into account as well. So, again, see if it's right for your portfolio. If you're not a client, I think it's an interesting story for you to consider, but make sure you consider the potential risks as well going into an environment where it looks like the economic data is starting to cool. Okay, so take a look at Parsons. Broadcom, symbol AVGO. They released their earnings just this week. They're kind of off cycle. Broadcom is a name we've had for many clients for a long period of time, and it's interesting. We originally bought the stock a number of years ago before AI was really a thing. I mean, well, it was a thing, but more conceptually it was a thing. It wasn't something that Wall Street was reacting to. They had, at that time, exposure to most of the up-and-coming technology trends, whether it was 5G, whether it was cell phone build-out, whether it was data center build-out. So that's why we liked Broadcom. And then, of course, they acquired VMware, significant software capabilities. So they were one of the more diversified technology companies of any in the S&P 500. Some of those legacy businesses have been in a cyclical downturn, primarily their wireless business, really their telecommunications business in general. If you look at their most recent quarter, those legacy businesses that were soft look like they're starting to bottom out and maybe get a little bit better, so we may start to see a bit of a tailwind there. Their software business was great guns, but the thing that everyone's talking about is their AI-related business, their chip business. And it's interesting how they kind of relate to NVIDIA. Obviously, everyone talks about NVIDIA. Broadcom plays in a slightly different sandbox, if you will, in the sense that they're involved in kind of high-end, really not so much, sort of more customized chips. Okay, so a company like Google or Facebook, now known as Meta, they have highly customized business needs that aren't necessarily being met by what a company like NVIDIA is producing. Okay, so Broadcom has a really good kind of niche there. They're the number 2 player behind NVIDIA in overall AI-related chip production, but clearly have a leading position, the number 1 market share leader in these ASIC chip designs, these customized chip designs. And you saw that show up in their earnings. Their results were much better than consensus, driven by AI and software. They took up not only their overall revenue outlook, but specifically their AI revenue outlook. And that was versus FactSet estimates. Okay, so the knock on Broadcom is probably the knock on all these chip stocks. Valuations have stretched significantly, now trades over 30 times earnings. I think when we bought it originally, it was literally 12 times earnings, if I'm not mistaken. And we just don't know how that competitive landscape is going to change, if these companies, all these chip companies, are going to be able to keep up their current profit margins and margin profile. So that's the risk. That's the risk. But from a top-line perspective, things look pretty favorable there. So I'm not sure. I mean, you obviously have to make your own decisions. We're probably not chasing the stock here at this point, just like we're not really interested in chasing any of the big chip stocks. But that's something that you would need to decide for yourself, and make sure you do your own homework, like I said, in the context of the current valuation, because that is the risk. The risk is you're paying over 30 times earnings at this point. Last thing I just wanted to mention briefly is Apple. And what's interesting about Apple is they just had the release of essentially their first real release to talk about sort of where they're going with AI. And what's happened is just in 3 business days, there's something like 340 billion added to Apple's market cap. 340 billion in 3 days. And I think what that is the first wave of this AI has been companies directly involved in AI architecture, right? It's been NVIDIA, of course, has been the flagship, but it's been the actual companies directly benefiting from it, and then the companies directly using it in their technology platforms like Microsoft, Google, companies like that, Facebook. Now we're starting to see Apple might be kind of the first company, sort of non-tech company, even though some people call them a tech company, but they're more of a consumer company. The first sort of consumer company to really articulate how they're going to incorporate AI into their experience. And clearly, what Wall Street is saying is that it is going to lead to a significant upgrade cycle for Apple. I mean, there's a reason why the stock went up over $300 billion in market cap, because people think that with installed AI capabilities, specifically significant enhancement to Siri, that's really the main innovation here, that's going to drive a whole nother level of growth for Apple. That, of course, remains to be seen. We don't know that yet. We haven't even seen the new phones yet. They don't come out till this fall, but that's what Wall Street is kind of forecasting. So I think it's interesting that Apple broke out to a new high after essentially having done nothing over the course of the last year. It's been, along with Tesla, they've been the 2 laggards of the big mega cap tech names, the Magnificent 7 names. So stay tuned. We'll see what happens with their new technology, but I just think it's interesting how this could be the next wave of AI, how regular companies, healthcare companies, consumer staples, consumer companies are integrating this technology. What does it mean for not only their sales, but what also does it mean for their actual execution, for their profit margins, for their productivity? So that's what we're going to be focused on. But I'll say it one more time. When I mention the NVIDIAs of the world, the Broadcoms of the world, Apple, I'm not telling you to go out and buy. I'm just telling you that these are ideas that are interesting for you to consider. If you're not a client, you need to make sure you do your homework, see if it's actually a suitable investment for your portfolio. Hope that was helpful. And as always, I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.